The shocking truth is revealed. I'm your host, Steve Metre, and thanks for joining me today. In our show today, it's the Biden administration's bombshell admission about the economy, because we've continued to hear from the political elites how strong and robust the U.S. economy is on the back of a strong labor market. And now we're finally hearing from those at the top that maybe the labor market is nowhere near as strong as they've tried to convince us that it is. The problem is we're seeing further cracks in the U.S. economy that now suggest and confirm we're in the early stages of a recession on our way into an all-out financial crisis. Now let's head over to Bloomberg, where we picked today's story up as Powell flags rising risk to jobs while avoiding rate cut timing. And we've continued to hear from Fed Chair Powell, who will speak later this month at the FOMC press conference, how strong the labor market is and how it's powering the U.S. economy and could drive an entire second round of inflation. And this is something that the data has not matched, but yet we continue to hear that it is strong and robust. And now he's changing his tune as speaking to lawmakers on Tuesday. Powell is careful not to offer a timeline for interest rate cut, which investors are now betting will begin in September. But he emphasized mounting signs of a cooling job market after government data published on the July 5th showed a third straight month of rising unemployment. And this is a shock move from Powell, who said that the unemployment rate would peak around 4%. It's now sitting at 4.1, on its way to a critical level. If it gets over 4.4, watch out, because historically it means once people start hitting the unemployment line in mass numbers, it doesn't stop. And he's now suggesting that indeed the U.S. labor market is not as strong as he hoped. Elevated inflation is not the only risk we face, he said. The latest data shows that the labor market conditions have now cooled considerably from where they were 2 years ago, and it wouldn't have said that until the last couple of readings. And this is a shock admission from the Fed chief, who now is confirming that the U.S. labor market is not as strong as they believe. And this is a huge red flag for the U.S. economy, because if the labor market starts to go, well, then everything comes unwound. And this is a surprise move from the chief, who said that the unemployment rate would peak right around 4%, and if it breaks through 4.4, this is a critical level for the unemployment rate, because history shows if you get over 4.4, well, you see a mass acceleration to the upside, as Americans will hit the unemployment line in droves and have no opportunities to work. And the evidence is clear as we look at the consumer price index. And what's shocking is that Powell says there's still upside risk here, but not if the unemployment rate continues to go higher. We go all the way back to the 1950s, and here you see the unemployment rate in red rising against a declining consumer price index that's shown in blue on a year-over-year rate of change. And they look somewhat like a mirror of each other, because where the unemployment rate goes, well, the consumer price index goes in the opposite direction. You see that even in the 1970s, although with a little bit of a lag on consumer prices. As we move into modern times in the 1990s, what do you see as the unemployment rate rises? Well, inflation falls immediately. And this happens simply because, as we know, people hitting the unemployment line do not have the same spending power they do when they're employed, because their incomes go down. But something that's going down that you should have made a bunch of money on, well, that's crude oil. Here we see the headline: oil prices now fall 1% as market assesses tropical storm Beryl impact. And what we know is back on June 12th, we alerted our subscribers to our CTA Timer Pro report. This looks at machine positioning. We look at discrepancies. When the machines are deep short and prices moving against them, that is our signal to our subscribers to put a trade in. And now we were stopped out on July 8th. That was a nice 4.87% gain. And notably, this wasn't a very stressful trade, because all we do is we give you the reports, the signals. I give you my opinions on which are the best trades and why. I give you stop loss levels. We track our trades and the returns and update our stop loss levels for you each and every week, making this a stress-free way to trade. And here's the best part, is you can start out with a 30-day free trial. Links in the description below, not only for our machine traded program, CTA Timer Pro, but for Momentum Timer Pro as well. Join join in, start making money. You don't have to go and be stressed out about trading. We make it easy because Powell's focus is now squarely on the labor market. Further softening of the labor market, even if further disinflation is not delivered, is enough to spur action. And that is absolutely correct, because what happens from the Fed's perspective is they've tried to bring inflation down, even though we know, and I'll show you, there's no historical relationship between inflation and the federal funds rate. But when the labor market starts to go, well, the Fed reacts immediately, because they know once people start hitting the unemployment line and their incomes go down, well, that means their spending power drops and other people lose their jobs. It's a domino effect that once it starts, you cannot stop it. And still, the Fed chair emphasized that cutting rates too soon or too much could stall reverse progress on inflation, which has come down from a peak of 7.1% in June of 2022. We'll have the latest update. It's at 2.6 right now as of May. We'll have, of course, tomorrow the latest data. But the evidence is clear that the Fed does claim they follow the consumer price index, but they don't actually make policy based on. Here you can see the federal funds rate in red against the consumer price index in blue. That's shown on a year-over-year rate of change. And you'll note that the Fed is often cutting rates into rising inflation or ahead of a decline in inflation. This time is one of the few times that they raised rates aggressively. Inflation came down, and yet they still believe they need to keep rates high because they're afraid of what happened in the 1970s, which is just evidence that the Fed does not understand how the monetary system works or our modern economy. And yet you do see a reaction when the labor market goes. If you want to know what the Fed really cares about, well, you take a look at continued unemployment claims shown in blue against the federal funds rate. And what you know, rising continued claims, which is evident as people lose their job and then are stuck on unemployment because the labor market isn't creating enough jobs. Well, that gets the Fed's attention in a big way, and they aggressively cut each and every time, suggesting that any further increase in continued claims would likely get the Fed's attention. At this point, it's probably not likely for their July FOMC meeting. Watch out for September, because the odds are continued claims, and we'll get some new data on that tomorrow, are going to continue to head higher, because we are hearing from employers they just are not hiring at this time, do not have demand for labor, and that's not a good sign for the economy, but it all points to a Fed eventually cutting rates. And Fed officials have welcomed recent data indicating inflation is decelerating again following an unexpected jump in prices at the start of the year, though several have said they need more confidence that the trend will continue before reducing borrowing costs. They want to actually drive the U.S. economy into a recession before they start cutting rates, because they talk about how there's a lag of policy in terms of monetary policy and how it affects the economy. But when it comes time to cutting rates, it seems like there's no lag. The Fed just doesn't get it. The monthly report on consumer prices due Thursday from the BLS is expected to show another 0.2% rise in the CPI, excluding food and energy, or what's known as the core, which would mark the smallest back-to-back gains in August. And it's very clear the labor market has cooled considerably. The alarm bells aren't sounding right now, but you are certainly pointed in that direction. And if continued unemployment claims continue higher, that means initial claims will start to go up, and then the alarm bells will sound loud and clear. And by the time that happens, it will be far too late for the Fed to react due to the alleged lags that monetary policy has in transmitting to the real economy. But when we turn to you small business owners, well, they might be optimistic, but a lot of them aren't going to be around much longer. As U.S. small business optimism rises to 5-month high on earnings, and check this out, the National Federation of Independent Business Index of Sentiment rose 1.3 points last month to 91.9, the highest since July, and matching the best reading of last year. And owners were less downbeat, but notably still downbeat about the outlook for business conditions, and only a net 4% expect lower sales in the next 3 months, the smallest share in nearly 2 years, as perhaps things have gotten so bad for small business owners, they're turning to hope at a time when we've seen evidence that consumers are spending less and likely to spend less, because while small business owners are optimistic sales are going to maintain their current level, the problem is the wages and hours worked are not. And small business owners remain very pessimistic about economic prospects this year. Inflation and labor quality have consistently been a tough complication for small business owners, and they are not convinced it will get better in 2024. Well, the truth is they're going to have more people to pick from. The problem is small businesses are facing a big problem, and it's called bankruptcy. As business bankruptcy now jumped 34% in the first half of 2024. If you want to talk about a soft landing or no landing scenario, this is not the data you should be seeing, because what it indicates is, as we've said happens, when you invert the yield curves and money curves, you constrict the creation of credit in a debt-based economy. And at some point along the way, the music stops, and the problem is there isn't enough money to pay on all the debts, and that means you see delinquencies and then eventually bankruptcies. The problem is they're here now. A total of 3,016 commercial Chapter 11 bankruptcies were filed in the January to June period this year, up a whopping 34% from last year. Small business filings, check this out, while they remain less pessimistic, their filings rose by 61%. Total bankruptcy filings rose by 15%. With individual filings increasing by 15%. The continued increase in bankruptcy filings reflects a growing economic strain on businesses and households. And here we see Michael Hunter, the vice president of bankruptcy data provider Epic, said he expects an increase in individual filings ahead, especially in considering the large increase in commercial filings, consumer debt levels, high interest rates, and overall increased costs with relatively flat household income. Well, Michael, there's one thing you're missing. That's rising unemployment, because when you see workers hit the unemployment line, they're going to be tapped out now as it is, but with even less income, their only option is going to be to head to bankruptcy court. And according to S&P Global, there have been 275 corporate bankruptcy filings in the United States so far this year until May, and that's slightly lower than 277 filings last year during the same period. However, get this, it's the second highest filing number during the January to May period since 2011, indicating that we are indeed in the early stages of a recession. But one part that everyone seems to agree will not face a recession is the housing market. But hang tight, things are changing there too. As now Zero Hedge notes, housing market cracks. A record number of listed homes now have price drops. And we said this would happen. You know, when builders go in crazy and build a lot of inventory on speculation, which they tend to do, and then they don't have the buyers, they will compete with the resale market by lowering their prices, will force the resale market to lower their price. And because there's a lack of demand for people buying housing at these elevated prices and interest rates, well, what you're seeing is a potential all-out price war to the downside. And we're now seeing it in the latest Redfin home price data, where among other things, we find as average home sale prices hit new all-time highs, the number of actual transactions has collapsed while the number of new listed homes is surging. But last but not least, the number of price drops reported, which that is what those who need to extract the money from the real estate yet can no longer afford to live in the mark-to-myth world created by the record bid-ask spreads, just jumped to the highest on record. That means, of course, households are getting strained. They need to sell property, and they're looking to cut prices. And when that happens, you start to have bidding wars to the downside, not by buyers, but by sellers who are competing for fewer and fewer buyers, as people, of course, don't have money to spend on housing. And perhaps the most important data point, while in the past sellers had the luxury of just waiting out the lack of buyers, the first true crack in the market has finally appeared, because sellers are finally starting to chase bids, which are not rising, and the number of listings that had price drops surged to 6.9%. Here you can see in the blue line, that is the highest on record. Normally going into the summer, you see that start to roll over as we head into the second half of the year. This time, it looks like there's nothing going to stop it from increasing. And that means unless the Fed cuts rates significantly, something nobody really believes, except perhaps myself, in the next few months, the housing market is on the verge of creating its own reflexive and self-reinforcing liquidation spiral as more sellers cut prices, forcing even more sellers to cut prices until suddenly the specter of a full-blown housing crash returns. And if you think that that won't be on the back of a lot of people losing their jobs, it will. The real estate market is a large employer. And of course, if you start seeing prices go down and people start bidding the price value of their home lower to find a buyer, well, that means you won't need as many people in the real estate industry, because the builders won't be building that much. It's going to be an all out crisis, as now we are confirmed the U.S. labor market's in danger. The Fed has admitted it. Small businesses are filing bankruptcy at a rapid rate. And now the U.S. housing market is setting up the perfect storm, my friends. And in only a matter of months, it'll be very obvious we're in an all-out recession on the cusp of a full-blown financial crisis. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.